Welcome to the Wealth Studying Podcast. This is episode 504. Today is December 27th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, I hope you've had a Merry Christmas. This year, the Pugliano family has been even more blessed than usual. Shortly after midnight on Christmas Day, our 13th grandchild was born, so we have much to celebrate, as I hope you do too. Well, hey, speaking of celebrations, let's look at the market. I'm going to try and get at least one more episode in before year end, but I'm receiving a lot of questions again about the AI bubble, and so that's what I want to talk about in this episode. The concern out there is about the bubble because, the media creates that narrative. I want to make the argument that I don't think we're in a bubble, not yet anyways. At this point, I think it's purely business cycle and way early stages of the business cycle. And I think rather than an AI bubble, this economy is set up for long-term secular growth. And this is no new story here. You've heard me talk about this for probably 18 months. So let's set aside all the media narratives and let's look specifically at some logical possibilities, right? I say possibilities because I can't predict the future, but I can sniff out BS in the media. The big reason there's fear right now about an AI bubble collapsing or popping is because that's what you're being told. But make no mistake about it. Look at the numbers. The comparisons of today's environment to the dot-com bubble are not logical. They're not logical and they can't be justified in terms of profits, cash flow, valuations, productivity improvements. Pretty much no matter what metric you look at, today's market is not anywhere close to the irrational exuberance that we saw that led up to the dot-com bubble. I call this a manufactured media narrative crisis because I think that's what it is. Look at earlier this year. All the panic that broke out over the Chinese version of their first AI model, which was called DeepSeek. I called it, I think, deep fake back then. You have to be skeptical of anything that comes out of the CCP. But think about how there was so much fear about this competitive product coming in from China. And, here we are 11 months or so later. You don't really even hear about DeepSeek because its impact on companies like hyperscalers or on the semiconductor companies like NVIDIA, the impact from DeepSeek is negligible. And how are we ending up the year in terms of the fear about the AI bubble? Similar thing we're seeing with Oracle. Over the last couple weeks, the biggest justification for why the AI bubble is popping or has popped is because Oracle has fallen apart, down something like more than 40% from its high. But let's step back and dissect that. I don't remember coming out at all and really even discussing the Oracle situation because I thought it was overblown. And the funny thing, or not the funny thing, the consistent thing about media narratives is that the same talking heads that back in September were telling you about the Oracle miracle and how it was going to the moon, they're essentially the same talking heads that today are telling you that the AI bubble's collapsing because of Oracle's falling apart and dropping 40%. Well, Oracle should have never gone up 40%, and likewise, that's why it came down. Oracle today, even after the huge sell-off, is selling about where it was over the summer. And in fact, it would be higher than that if all the hysteria hadn't risen it up so high and then made it collapse so low. Its 200-day moving average is maybe, 4 or 5% higher than where it is right now, right around, 215, 220. And that's about where it should be. That's probably at least fair for this environment, if not, being a little higher than that. But the bottom line with Oracle and all the panic about it collapsing in price is that year to date, it's still up almost 19%. How's that for a collapse? Same thing with NVIDIA. Sure, its growth has slowed down from where it was, over the last 2.5, 3 years. That's a natural part of a business cycle. Trees don't grow to the sky. Growth eventually tapers off. But NVIDIA's stock price, year to date, up almost 42%. That's not the collapsing of a bubble, certainly not yet. Most of the Mag 7 and hyperscalers are doing just fine, even after having extraordinary growth over the last 3 years. You heard me recently talking about Google, how I doubled down on Alphabet, of course, I call it Google, but how I doubled down on it back in, I don't know, October maybe of 2024. Going back a year ago, everybody hated Google. They thought it had fallen behind Anthropic and OpenAI, and Google was just never going to catch up, and all of its advantages from Chrome and online search, and that was all going to go away. Well, look at the scoreboard. Google, year to date, up over 65%. So no, this doesn't look like a collapsing bubble, at least not yet. Again, looks like just normal business cycle rotation, where the profits and the growth and the enthusiasm move throughout the supply chain. In terms of artificial intelligence, it has to start first with the NVIDIAs of the world, because they have to invent the new silicon chips that enable the technology to begin with. And then you need that to be adopted by hyperscalers, which drives sales for a company like NVIDIA, and it causes investment from the hyperscalers. But then their businesses grow, and also along that way, there's advantages and opportunities for other hardware companies, because it's not all about semiconductors, right? Go to a data center. There's a lot of switches and controls and copper and fiber optics, and there's more than all that accumulatively than there is in any one chip that's going to come out of NVIDIA. So the growth then moves from NVIDIA to these other suppliers and other service providers. That's where I think we are in this business cycle. Not a bubble, but a business cycle. A cycle that's long-term and is creating secular opportunity. After the price of Oracle started to collapse and all the fear was coming out, at the end of the year about this bubble bursting, what made prices stop going down? And in fact, most of the indices from the S&P 500 to the NASDAQ and even the small and mid-cap stocks, they all reversed course and started going back up. And why was that? It mostly came down to when Micron, and to a lesser degree, Jabil announced the earnings I think it was maybe 2 weeks ago. Micron has been on a tear all year. You've heard me talk about it earlier this year. It's in my portfolio. I think I bought it in mid to late January, maybe early January. It's an old school technology. That's what I talked about it then, back like things like Seagate and other, commodity producers of hardware like memory. But that's exactly what you need. And again, part of the flow through the business cycle. It starts with semiconductors, and then it moves to other areas of hardware, and then it'll move to software companies, and eventually the productivity gets realized when end users adopt that technology and are able to become more profitable. Well, look at Micron. Just since it made that announcement of its earnings, again, maybe 2.5 weeks ago, up something like 30%. But that pales in comparison to where it's been all year. It's up like, I think, almost 240% year to date. This is from an old, stodgy commodity producer of memory chips. But you need this to go along with all the explosive growth that's happening throughout the supply chain. And Micron stock just didn't bounce up like Oracle's because it got some flashy hype from the media. Its order books are full, and its quarter-over-quarter profit growth was in excess of 50%. This is already after having a fantastic year. So, no, I don't see this as a bubble. Again, not yet. It'll probably get to that point. But there is still real money and real profits being made in this AI trade. And that takes me to the other announcement, and this was not really on anybody's radar because it's a company called Jabil. Most people have never heard of it. If you remember, I did an episode about it back earlier this summer. Check that out if you haven't listened to it. It's episode 476. Entire episode was devoted to Jabil, and I think I entitled that A Stock You've Never Heard Of. Well, year to date, they're up 64%. They've been trying to break out for an all-time record high since the summer, and although they're hitting resistance at about that $230-ish level, I think they could literally double from where they are right now. And again, the reason for this is because they have substantial profit growth because they're a North American supplier of the nuts and bolts part of the data center and artificial intelligence circuitry and circuit boards. And again, more importantly, it's not just they design these things, but it's that they actually make them here in North America. That's been a trend going forward since the pandemic, and with all the continued geopolitical issues, it's not going away anytime soon. This is a long-term trend that's probably going to go on for a decade or more. The reshoring and the nearshoring of critical components, not only for the U.S. economy, but even specifically for national security reasons. And so no surprise when they announced earnings just a week or two ago, this little, pretty much unknown, unassuming, fairly low profit manufacturing company saw that its profits were not only up significantly, but specifically to AI-related revenue, it was up over 35% from last year. And again, this was after those projections were, astronomically high from previous years. So the growth is real, and it's moving through different areas of the economy and the supply chain. This is really not about artificial intelligence, it's about electrification. And, again, this is something you've heard me talk about going back since before 2016, because that's when I wrote the book, The Robots Are Coming. And yeah, it was all about robots and automation and digitization, but none of that occurs without electrification. And so it's not only the hyperscalers that benefit, or not only the semiconductor companies that benefit, or even the old school memory chip companies, but it's throughout the economy. And that's why I think that this could be, and likely is, a long-term secular growth play. Look at the price of copper. It's critical to electrification. Oh, and yeah, some of the increases have to do with the hype around, the broad moves we've seen in precious metals and what's likely going to happen with tariffs. That's an impact as well. But overall, if we're anywhere close to the projections of where we're going to be with electrical demand in the next 5 to 10 years, we just don't have enough copper to get there. Now, I personally don't invest in commodities. It's not something that I normally do. I've occasionally dabbled into it with, ETFs that are focused on that area. But rather than buy commodities, I like to buy companies. And so, I do own several copper mines. And those, incidentally, also, as part of mining copper, also mine things like gold and silver and other metals, but primarily copper. Look at Freeport-McMoRan, up over 40% year to date. Southern Copper, even better, up over 68% year to date. And when you have basic industries like copper and copper mines being up so much, again, that carries over with a secular trend throughout the economy. You remember going back, sometime 2024, I bought into railroads. Now, they're not all doing spectacular because, some companies are run better than others, but look at CSX. Old Stodgy Railroad up almost 14% year to date, and Norfolk Southern up almost 24%. If you're mining all that copper, you have to move it on railroads. And it's not just about copper. Look at Ciena. Again, in my portfolio, you've heard me mention it, this past year. They're a telecommunications company, but the real forte is dealing in high-speed communications, meaning fiber optics. And, going back to that dot-com bubble, there's a lot of dark fiber that was laid back in the late 90s and early 2000s. That stuff was laid, it's paid for, it's never been used. Well, it's starting to be used now. That's a stranded resource that's coming back online, and companies like Ciena that build the hardware and the nuts and bolts that connect that fiber optics to the data centers, they're flourishing. Ciena, again, probably a company you've never heard of, up year to date, 185%. Now, does that sound like a bubble that's burst? No, again, I think we're still in early stages of this business cycle, because it's not isolated to a handful of companies like it was 3 years ago. It's moving throughout the economy. Real nuts and bolts, infrastructure type companies that are not only have sales, but are profitable. The list goes on. You've heard me talk about Amphenol. That's one of my all-time favorites, being a ham radio operator Amphenol's the company that, I don't know if they invented it, but they certainly dominated the industry back in, I don't know, the 1940s or something, when they made the UHF connector that's common on ham radios and things like coax for CB radios. Well, yeah, that old school technology company, they didn't just stay making simple parts. They make very complicated connectors now. And again, any data center is full of them. They're up just shy of 100% year to date. This is from a company that's like 80, 90 years old. Another old company, Corning. Again, in my portfolio, I've talked about it at least in one episode. Year to date, up 88%. Again, I can go on and on. Flex, Johnson Controls, Vertiv Holdings. And while these things are all, again, pretty much directly tied to electrification, what about a company like Flowserve? Now, it's had its up and downs, particularly over the last year, but still it's up like 23, 24% year to date. And Flowserve, again, an old company, probably at least 50 or more years old, they manufacture the valves that are used on petroleum and natural gas pipelines. Because it's not just about copper, it's still all about fossil fuels. And then, of course, there's the energy of the future, which is nuclear. You know I'm in that in a big way. And again, you've never heard me talk about these high-flying, non-profitable companies that are making claims about, what's going to happen with newer nuclear technology. I'm not into the unprofitable, unproven companies, but I certainly, over the last year or more, have bought into the uranium and the nuclear trade when it involves profitable companies. That started going back a couple years ago when I heavily invested in the utilities, and those utility investments were very much focused on regulated utilities that have above average nuclear reactors in operation. You may not realize this, but there's some 98 or more active nuclear reactors. And so I early on wanted to get into those companies. And then as I saw the real demand for electricity continuing, I specifically jumped into the overall nuclear supply chain. And so that involved, again, these companies are no secret to listeners of the Wealthsteading podcast. Been talking about them for probably 18 months. Cameco is a Canadian company. They're a uranium miner. So that's starting in the most upstream part of the uranium supply chain. Year to date, they're up over 80%. And then once you mine the uranium, you have to refine it. And so I'm heavily invested in a company called Centrus Energy. Now, again, they've had their ups and downs this year. They went hyperbolic in October. That fell apart, but even with the decline from the October highs, are you ready for this? The stock is still up 281% year to date. It's been building a base for the last 2 months. I think it has extraordinary future potential because not only is it a uranium refining company, but it's the world's only non-government, meaning it's a private company. It's a private company that refines uranium, and better than that, guess what? It's located in the good old USA. So again, plays along with that trend of onshoring and nearshoring and friendshoring, and ultimately the national security play that is a decade-long trend. But we're not done there, because I also, after I had heavily bought into utility companies a couple years ago, then when I saw this increasing trend of nuclear energy, I wanted to own not only a utility company that was involved in the nuclear trade, but one that was specifically, nearly 100% pure play. And that takes us to Constellation Energy. And again, this is not a pie-in-the-sky company. This is a company that's profitable. They're not trying to do something in the future. They're doing it today. And again, had a big run-up in October. It's pulled back from that, been consolidating for a couple months. It's still up over 60% year to date, and I think it has a lot of room ahead of it. One more thing about old stodgy companies that are benefiting from this high-tech trade, look at a company like Cummins Diesel. Again, you've heard me mention that earlier in the year. It's in the portfolio. It's up almost 48% year to date because although they make those dirty, nasty diesel engines that run on fossil fuel, guess what? You need that to mine the cobalt and all the other things for the EVs, and you need that to mine the gold and the silver and the copper. And in many cases, those diesel engines are running the railroads, which are hauling all that material. Listen, I think this is not a bubble, but a secular growth trend. And I'll end on this note. The next logical place this takes us is not only the supply chain of artificial intelligence, but ultimately the real money is made in the companies that increase their productivity by adopting this new technology. Technology is all about reducing variable cost. Again, a point I made in my book many years ago. As I read the tea leaves going into 2026, I think the industry or the sector that is going to benefit the most short term from implementing artificial intelligence is going to be the financial sector and specifically the banks. And so that's why going back a couple months ago, you saw me jump into 3 ETFs. That's regional banks, large money-centered banks, and insurance companies. And while the insurance companies are lagging a little bit here, up only a couple percent, and I think that has more to do with government regulation, but we'll get that in a second. Bottom line, regional banks, just since I bought them, up almost 8%. And this is going back, I don't know, check the blog, but early October maybe. And then the big money center banks up right at 7%. I think these could show explosive growth in the next year or two as they reduce jobs and increase productivity because of adoption of artificial intelligence. And then beyond this, and this is, short term, yes, the insurance companies are getting hit with more government regulation and oversight, but all that or much of it is being removed from the banking sector that's been plagued by overregulation for the last 18 years. I think you're going to see the fruits of that really paying off starting in 2026. So, hey, I've talked too long in this episode. Bottom line, I don't think there's an AI bubble. And while we'll hit speed bumps along the way, I do think that we're in an overall secular growth trend. And I encourage you to come back for future episodes as we see how this whole thing rolls out across the economy. Hey, until then, as always, this is John Pugliano wishing you the very best returns.